Welcome to the Deep Dive. We're here to cut through the noise, get straight to the insights you really need. Think about your day for a second. That smartphone in your pocket, right? Does everything from your alarm to helping you unwind. Or think about the factories humming along, making all the stuff we use. They rely on complex automation. Well, behind all of that, there are these tiny semiconductor chips, kind of the unsung heroes. And very often, working quietly behind the scenes, powering so much of this, is a company like Texas Instruments. But here's the tricky part. How do you actually assess a company like that? I mean, they're a long-standing leader, sure, in a really foundational industry, but it's also notoriously cyclical. And what makes it even more complex is when the experts, the analysts we often look to, have such, well, dramatically different views. Some are shouting buy, projecting huge upsides, while others are much more cautious, even saying sell. It's that huge range of opinions that makes TI so interesting for us to dig into today.
It really is fascinating, isn't it, how a company so fundamental, so integrated into everything, can still spark such debate, a real quiet giant. Yet look at the spread in analysis. It just highlights the complexities, doesn't it? Valuation, market timing, especially in such a dynamic field.
Absolutely. So today we're taking that comprehensive deep dive into Texas Instruments, that's ticker TXN. A real powerhouse in analog and embedded semiconductors. We've gone through a stack of detailed reports, analyses, you name it, everything from those initial BUI calls seeing massive potential to more cautious hold ratings saying, hang on a minute, and even some pretty stark sell recommendations after recent earnings came out. It's a really fascinating study in how market perception, short-term sentiment can really clash with what seems like a solid long-term strategic vision.
And that's our mission today, really, to unpack all these different sources, distill what's essential, and help you, our listener, wrap your head around what's actually going on with Texas Instruments. We'll explore those unique competitive advantages they have, these huge strategic investments they're making, the ones really reshaping their future, and, of course, the recent financial performance that's caused all this disagreement.
Exactly. They want to give you that comprehensive understanding, but without, drowning you in jargon or overwhelming detail. Think of this as your shortcut to getting properly informed. We'll look at the company's foundational strengths, those recent challenges it's faced, and what these analysts are really projecting for its future. So yeah, let's unpack it. Let's get straight to the facts, understand what makes this quiet giant tick, and why it's sparking such a spirited debate right now. Okay, let's kick things off by really getting to grips with the core of Texas Instruments. What makes this company such a formidable player in the semiconductor world? When we talk about Texas Instruments, or TI, we're talking about a really high-quality analog and embedded semiconductor company. And crucially, it's not just another player. It's the largest global supplier of analog semiconductors, full stop. So this isn't just, some chip maker. This is a quiet, yes, but undeniably powerful giant, underpinning so much of how we live digitally.
Indeed. And it's worth just pausing on its history, its longevity. Founded way back in 1930, still based in Dallas, Texas. That long history speaks volumes, right? About resilience, adaptability. And yeah, while many of us probably remember their calculators from school, those TI-83s or whatever, helping us through math class.
Oh yeah, definitely.
That's just a tiny, visible sliver of what they actually do. The calculators are almost like a nostalgic nod, but their core business is much bigger, focused on industrial, automotive components, that kind of thing.
Exactly. And when you really start digging into its core strengths, you see a company that looks engineered for durability, for consistent value. TI is known for a shareholder-friendly capital allocation strategy, which, let's be honest, is often music to investors' ears. It has strong pricing power, suggesting its products are pretty essential. And maybe most importantly, it has this wide, deep competitive moat. And that moat really comes from its huge manufacturing scale and its incredibly diverse customer base. Makes it very tough for competitors to really challenge them head on.
And what's really interesting here, and a key reason we're diving into TI now, is what's been happening with its share price recently. Despite these, rock-solid fundamentals we're talking about, there's been a decline. And some analysts are pointing to this decline as a potentially compelling entry point. That thinking is that these cyclical headwinds the whole semiconductor industry is facing might actually be hitting a bottom.
Okay.
Which could set the stage for a significant earnings recovery fairly soon, making it maybe an opportune moment, though perhaps a bit counterintuitive, to look at the company as an investment.
Right. So to really understand how TI works, we need to break down its two main business segments. Let's start with the big one, analog. That accounted for, what, roughly 75% of their revenue in fiscal 23.
That's
That's the core.
Absolutely. In the analog segment, TI makes these essential components, the real workhorses of electronics. Things like power management chips, signal chain devices.
Like what specifically?
Think data converters. They translate real-world signals like temperature or sound into digital data. Or amplifiers, which boost signal strength. These are absolutely fundamental. They power everything from complex industrial automation, critical automotive systems, communications gear, even the personal electronics we use every single day.
And this is where TI's edge really comes through, right?
Yes.
Sets it apart. It's not just participating here. One source called it the de facto industry leader, supplying chips for over 80,000 different analog products. That number is staggering. But the really critical insight for you, listening, is that most of these products have long product cycles. We're talking 10, maybe 15 years, sometimes even longer.
Right?
This isn't like smartphones where things change every year. It's stable, predictable, almost like an annuity once those chips get designed into a product.
Then you've got the embedded processing segment. Smaller, about 19% of FY23 revenue, but still very important. This deals with things like microcontrollers, tiny computers on a chip, various processors, connectivity chips that let devices communicate. Essentially, they're the brains and the communication hubs in vehicles, industrial machines, and, all those billions of Internet of Things or IoT devices popping up everywhere.
And our sources describe this segment as extremely sticky. Why sticky?
It comes down to the custom software needed to integrate these chips and the long design cycles involved. Once a TI chip gets designed into, say, a car's engine control unit or a factory robot, the cost for the customer to switch to a competitor becomes incredibly high.
Oh, okay. So they're basically locked in.
Pretty much. For years, often for the whole life of that end product, it's a powerful advantage. Creates real customer loyalty almost by necessity.
So this brings us to a really crucial distinction, maybe something that seems a bit technical but is fundamental. The difference between analog and digital semiconductors. Why does this matter so much? Most of the buzz is around digital, right?
That's a great question because most people are familiar with digital chips, the processors in our computers, the GPUs for gaming or AI from companies like NVIDIA, AMD, Intel. But analog is fundamentally different. It operates in a different realm.
Right. Let's simplify that.
Yeah.
Analog chips deal with continuous signals. Think real-world stuff. Sound waves, light intensity, temperature. These things vary smoothly, continuously. They reflect the nuance of the physical world.
Exactly. Whereas digital chips work with discrete signals, binary, zeros and ones. That makes them perfect for computation, logic, storing data. They are absolutely the heart of modern computing.
And this is the really interesting part, maybe the bit that gets overlooked with all the hype around digital. Digital chips, for all their power, cannot function in most real-world applications without analog counterparts.
Right, because the real world is analog. So for a digital system to interact with our physical environment, it needs translators. It relies on analog to digital converters, ADCs, to take that continuous analog information and turn it into digital bits the processor can understand and work with.
Your smartphone is the perfect example, right?
Yeah.
You speak into the mic, that's an analog sound wave.
Yeah.
An ADC converts it to digital data for the phone's processor. Then, when you listen back, a digital to analog converter, a DAR, has to turn that digital data back into an analog signal so the speaker can actually make the sound waves your ears hear.
Precisely. Analog chips are the critical translators, the bridge between the messy, nuanced real world and the clean, precise digital world. They're indispensable.
Okay, so that leads to a really significant insight from the sources, and maybe a surprising one. While digital gets all the headlines, the analog industry is described as much duller, more predictable, and less driven by innovation. Now, for many people listening, exciting usually sounds like a good investment. So is boring actually a bad thing here?
Well, that's the interesting challenge to conventional thinking, isn't it? We're kind of conditioned to chase the next big thing, the disruptive tech. But maybe that predictability, that lower hype, is actually a competitive advantage, especially for investors looking for returns.
Are you saying the data backs that up, that boring can actually outperform?
I am. And the sources show this isn't just theory, it's real. Analysts point out that the analog industry has actually outperformed its digital counterpart over the last decade. Leaders like TI and also Analog Devices have delivered incredible returns, 306% to 359% over 10 years, way better than many digital benchmarks. So it clearly shows that boring most certainly isn't a bad thing in investing. It can be a source of really remarkable, consistent returns over the long haul.
Wow, that's powerful. So what's the growth outlook then for this less glamorous but high-performing segment?
It looks remarkably strong and stable, actually. The projection is for mid to high single-digit growth, think 6% to 8% compound annual growth rate, or CAGR, well into the next decade. And the driver is simple: the increasing digitization of everything. As TI themselves put it, every time a system is digitized, there is growing need and opportunity for analog chips.
Right.
The more connected, automated, smarter our world gets, the more essential these analog translators become. It's a huge secular trend pushing things forward.
Okay, so we've got a clear picture of what TI does, how vital analog chips are, and even this interesting, boring is beautiful angle. But in a tough industry like semiconductors, super competitive, super capital intensive, you need more than just good products. You need that deep, defensible moat to protect yourself. So what are the core competitive advantages that really shield Texas Instruments? What makes them so resilient?
That's the million-dollar question, isn't it? Because advantage is everything here. And one of TI's biggest, maybe the cornerstone of their model, is manufacturing, specifically their infrastructure and cost leadership. Unlike a lot of peers who outsource production, the fabless model TI is highly vertically integrated, about 90% in-house manufacturing.
Okay.
That gives them incredible control over their processes and, crucially, huge cost efficiencies.
And it's not just about owning factories, it's about owning the right factories, the advanced ones. TI operates multiple state-of-the-art 300mm, that's 12-inch wafer fabs.
Right.
And these are way more efficient, something like 40% more cost efficient than the older, smaller 200mm fabs that a lot of competitors are still using.
To put numbers on that, on a 300mm wafer, they can get roughly 2.5 times more chips than on a 200mm wafer, but the production costs aren't 2.5 times higher, they're only modestly higher.
Why?
That's a massive economic advantage, scales right to their bottom line.
And that scale creates a huge barrier to entry, right, for anyone thinking of challenging them.
An incredibly high barrier. Building these advanced fabs costs billions, requires immense technical know-how, and takes years, literally years, to ramp up to full efficiency. It's a massive, multi-decade commitment. Very, very hard for newcomers or smaller players to even think about replicating.
And the benefits go beyond just cost, right? This vertical integration.
Absolutely. By controlling the whole chain wafer fab assembly, TI isn't as reliant on external suppliers like the big contract manufacturers, TSMC or Samsung. This means they can avoid the kind of peak cycle cost inflation that hits fabless companies hard when demand spikes and foundry prices go up.
Okay.
And the result? Look at their gross margins. Consistently impressive, often in the 60-70% range, even in down cycles. Like in Q4 2024, a tough period, their gross margin was still over 58%, significantly better than many competitors.
Then there's this other angle, increasingly important today. Geopolitical dependability. That's another part of their moat.
Hugely important. TI has explicitly stated they have limited manufacturing exposure to Asia and close to no exposure to China.
That feels like a massive strategic plus right now, with all the supply chain worries and trade tensions.
It really is. TI isn't just diversified. It's one of the largest semiconductor manufacturers in the U.S. Multiple facilities right here. That significantly lowers their geopolitical risk compared to companies heavily reliant on, say, Taiwan or other Asian hubs. It gives them a kind of insulation many peers lack.
And presumably, this positions them well for things like the GPS Act.
Exactly. It makes TI a top beneficiary of tax credits and government incentives aimed at bringing semiconductor manufacturing back to the U.S., strengthening domestic supply chains. You could argue it makes them one of the least risky semiconductor investments out there, at least from that geopolitical angle, another layer of resilience.
Okay, so manufacturing scale, geopolitical safety. What else contributes to this moat?
Their product portfolio breadth and customer diversity are absolutely key, too. They lead the industry with something like 80,000 different products, just an astonishing number.
Right.
This huge portfolio gives them access to an incredibly wide customer base. And critically, it means they can often sell more chips into each customer's application, deepening those relationships.
And does that diversity help smooth out revenue?
Definitely. They serve over 100,000 customers globally. The top 100 make up less than 40% of revenue. And crucially, no single customer consists of more than 10% of TI's revenue.
Okay.
So if one customer or one market segment hits a rough patch, it doesn't cripple the whole company. It makes their overall revenue much more durable and less sensitive to disruption. It's risk management built right in.
Now, here's something I find really interesting for the long-term picture. How sticky their customers are and those long product cycles you mentioned earlier.
Yes, this is huge. TI has strategically tilted towards industrial and automotive. Combined, that's now about 70% of their 2024 revenue, and these are markets known for stability and, yes, very long product life cycles.
How long are we talking for design cycles?
The initial design-in can take maybe 6 to 18 months, but here's the kicker. Once a TI chip is validated, qualified, and designed into a system like factory automation gear or a car's ECU, it usually remains for 10-20 years.
10 to 20 years. That's incredible in tech.
It's an astonishingly long time, and it speaks volumes about the integration.
Because switching out that chip mid-cycle is almost impossible.
Pretty much. These chips are often non-substitutable mid-cycle without a full redesign. Think about the hassle and cost. Recertification, tons of testing, firmware and software changes, potential delays getting the end product to market, and the risk of the whole thing failing with a new, unproven component.
Right.
It all adds up to extremely high switching costs. Customers are very reluctant to change once TI is designed in.
So once they win that design, it's almost like an annuity.
That's a great way to put it. It creates these multi-year recurring revenue streams. It's not just a one-off sale. It's a predictable revenue engine that keeps generating income for years and years. That stability is a massive differentiator in a typically volatile industry.
Okay, great business model, vertical integration, sticky customers. But a giant like TI needs fuel for growth. What are the big external trends driving their expansion? Why are these important?
Right, you need those tailwinds. And TI is definitely capitalizing on powerful long-term revenue drivers, especially the growth in industrial and automotive. These sectors combined have grown at about a 10% CAGR since 2013, and everyone expects significant future growth. These aren't just fads, they're fundamental shifts in how things are made and how we move.
Can you give some specific examples? In automotive, for instance.
Sure. Think about the explosion in ADAS, advanced driver assistance systems. That needs complex sensors, processing chips, or sophisticated powertrain controls, especially for EVs, battery management systems, fancy infotainment displays, all the electronics controlling windows, seats, lights. And get this, a modern electric car has roughly 4 times as many semiconductor products on board as a traditional internal combustion engine car.
4 times. That's a huge increase in demand per vehicle.
Massive. And TI's right there supplying many of those chips.
And in the industrial sector.
It's just as broad. Factory automation, advanced robotics, grid infrastructure for smarter energy management, precision medical devices, smart building controls. All these areas need more sophisticated, reliable, efficient chips. Exactly what TI excels at.
And beyond these specific markets, are there bigger, broader trends helping TI?
Definitely. 3 big ones stand out. First, just the general trend of increasing semiconductor content in everything. Everything's getting smarter, needing more chips. Second, reshoring. Governments, especially the U.S., incentivizing manufacturing to come back home.
Right. We mentioned the GPS Act.
Exactly. And third, closely related, is the push for geodependable capacity. Global efforts to build chip supply chains outside of traditional hotspots like Taiwan due to geopolitical risks. TI's big U.S. manufacturing footprint means it benefits hugely from these last 2 trends. It reinforces their position.
So all these factors, the moat, the sticky markets, these big trends, add up to significant market share for TI.
They do. As of 2023, they had about 3.1% of the total global semiconductor market. But in their core analog segment, their share was around 19% back in 2021. Undisputed leader in a critical, growing niche. It's a powerful position.
Okay, we've covered TI's really strong core business, those deep competitive advantages. Let's shift gears now and talk about the capital story. How do they manage their money? What about these big strategic investments? And ultimately, how do they plan to return value to shareholders? This is often where things get critical for investors.
Absolutely. And this is an area where TI really shines, consistently showing what sources call world-class capital efficiency. They boast a really impressive return on invested capital, ROIC. It's been significantly higher than its weighted average cost of capital, or WACC, for a long time.
Which basically means they're generating strong returns on the money they invest back into the business.
Precisely. It signals really effective, disciplined capital deployment, getting good bang for their buck.
And this isn't just by chance, right? It's part of their philosophy.
It's deeply ingrained. Their investor relations materials state their goal clearly: maximize the growth of long-term free cash flow per share. And they emphasize it's not just about cutting costs. It's about making disciplined investments that drive revenue, improve margins, keep expenses in check, and ultimately boost that free cash flow per share number. It's a holistic view.
Can we look at the actual ROIC numbers? How have they trended?
Sure. Historically, they've been fantastic, around 41% in 2020, up to nearly 49% in 2021, hitting a peak over 57% in 2022. Really strong. Now, more recently, there's been a noticeable dip down to about 30% in 2023 and under 19% in 2024.
Okay, that dip definitely catches the eye. Why the decline? Is it a red flag?
Well, this is a crucial context. The sources are clear. This lower ROIC recently is largely due to the fact that TI has been front-loading its Capex, meaning they've been spending unusually heavily on capital expenditures to build future capacity.
So the invested capital part of the ROIC calculation went way up even before those investments started generating returns.
Exactly. It temporarily skews the ratio downwards. It's presented as a strategic choice for long-term gain, not a sign that the underlying business became less efficient overnight.
And even with that dip, how do they stack up against peers?
Even during this heavy investment phase, they still look good comparatively. Their 3-year average ROIC remains higher than its peers. It was cited at nearly 42% compared to around 28% for both TSMC and Qualcomm. So even while making these massive future bets, their capital productivity still compares very favorably.
Okay, let's talk more about this Capex cycle. This seems absolutely central to the current debate about TI.
It really is. TI is right in the middle of a huge multi-year capital expenditure program. They've been front-loading $507 billion per year in Capex, primarily to build out more of that internal 300mm manufacturing capacity. We talked about projects like RFAB2 and LFAB. Just in 2024, they spent a massive $4.8 billion on this. It's a major strategic bet.
And this heavy spending is the main reason their free cash flow has looked underwhelming recently.
That's the direct cause. Free cash flow per share was only $1.63 in 2024, relatively meager for a company this size. And this creates that key question dividing analysts. Are investors seeing this dip in FCF correctly? Is it a temporary necessity for future growth, or are they focusing too much on the short-term pain and maybe punishing the stock unfairly?
Is there an end in sight for this heavy spending? Is it going to go on forever?
No, there's a timeline. Management projects' Capex will stay high, around $5 billion a year through 2025. But they anticipate potential reductions, maybe below $5 billion in 2026, as these big projects wrap up. The company figures it's already 60–70% through a 6-year elevated cycle. So the peak spending might be behind them, or nearly so.
Okay, that's critical for the future cash flow picture.
Yeah.
What's the expected payoff once Capex normalizes?
The expectation is pretty significant. As Capex comes down and these new efficient fabs start producing, TI is expected to enhance its free cash flow and shareholder returns significantly. They've actually put out a forecast projecting free cash flow per share could reach between $8 and $12 by 2026.
Wow, that's a huge jump from the recent $1.63.
Massive jump. It would dramatically strengthen their financial position, giving them way more flexibility for dividends, buybacks, or further investment.
And there's another piece helping them fund this, right? Government support.
Yes, that's a big help. Texas Instruments expects to get an estimated $6 billion to $8 billion from the U.S. Department of Treasury's investment tax credit. This is for their qualified U.S. manufacturing investments, largely thanks to the CHIPS Act. That's a substantial amount of money helping to offset the cash outflow during this heavy build-out phase.
Okay, let's switch to shareholder returns then. Dividends, buybacks. TI has a good reputation here, doesn't it?
A very strong reputation. It's been a consistent dividend growth pick. They've grown the dividend for 21 consecutive years. That's impressive commitment. And the growth rate has been stunning, a 24% CAGR over that whole period, and still a healthy 11% CAGR over the last 5 years. The yield was attractive too, around 2.9% as of early 2025.
Now, what about the payout ratio? If free cash flow is low, does the dividend look safe?
That's a fair question. Currently, the payout ratio does exceed 100% because earnings are temporarily depressed by that Capex cycle. However, the expectation is that it will normalize to between 40–60% once free cash flow recovers. That range should allow them to keep growing the dividend at high single-digit rates without needing extra debt. So it's viewed as a temporary situation.
And buybacks, are they active there too?
Very active historically. Since 2004, TI has bought back enough stock to lower its share count by some 47%. That's huge reduction, significantly boosting per-share metrics over time. Although one analyst did flag that buying back $500 million worth of stock in Q4 alone, a period when free cash flow was really tight, raised some eyebrows, questioning if maybe holding on to that cash might have been more prudent at that specific moment. A minor point, but shows the scrutiny.
And finally, overall financial health. Balance sheet, despite all this spending.
Surprisingly robust, actually. As of Q3 2024, they had $8.8 billion in cash. Against that, $14.6 billion in total debt. The weighted average interest rate on that debt was a manageable 3.8%.
So they are in a net debt position.
They are, yes. But it's considered healthy enough by most analysts, precisely because everyone expects that significant free cash flow recovery in the coming years. And backing that up, they have a strong A+ credit rating from S&P Global. The market generally seems confident in their long-term financial stability, even with the current FCF dip.
Right, so we've got the strong foundation, the competitive edges, this ambitious capital plan. Now let's get into the recent performance. How has TI actually been doing financially, and what does it signal? Keeping that industry cyclicality firmly in mind. This is where things get really interesting.
Okay, let's track the recent quarters. Q3 2024 results, reported back in October 24, offered that first real potential sign of a turnaround after a tough stretch. Revenue was $4.2 billion. Now, that was still down 8% compared to the previous year, which had been strong, but the key metric everyone seized on was a 9% sequential increase from Q2. That hinted maybe, just maybe, a recovery was starting, that the bottom might be in.
How did the different segments perform in Q3?
Analog, the biggest segment, was relatively resilient, down only 4% year over year, but embedded processing was still lagging quite a bit, down 27% year over year, so an uneven recovery starting. Digging into the markets served was also really revealing. Industrial, a key focus for TI, was actually still down low single digits sequentially, mostly because customers were still working through excess inventory built up earlier.
Okay.
But automotive was the big surprise. It showed a 7-8% sequential uptick. And this was especially strong in China, driven by EV growth. Automotive revenue there was up 20% sequentially, a definite bright spot.
And what about consumer-related markets?
They showed much clearer signs of life. Personal electronics jumped 30% sequentially, enterprise systems up 20%, communications equipment up 25%, strong rebounds there. Overall for Q3, gross margin was 60%, operating profit $1.6 billion, that's a 37.4% margin. EPS came in at $1.47, beating estimates, even though it was down 21% year over year.
But that free cash flow issue persisted.
It did, still low. $1.5 billion on a trailing 12-month basis, only a 9% margin. Still weighed down by that heavy Capex spending. Expected, but still a point of focus for analysts.
Okay, then came Q4 2024 results, and critically, the guidance for Q1 2025 reported in January 25. And this is where the optimism kind of hit a wall.
It really did. The Q4 results themselves failed to impress, but it was the Q1 guidance that really disappointed. It fell significantly short of expectations, and the stock reacted immediately, dropping over 7%.
Or the Q4 numbers?
Revenue was $4.01 billion, down only 2% year over year, so that comparison was improving slightly. And this was the killer detail, sequential growth turned negative at -3%. That suggested the recovery seen in Q3 wasn't just stalling, it was actually reversing slightly, a definite red flag for the market.
Where was the weakness coming from?
Particularly in those key markets. While the analog segment overall actually turned positive year over year for the first time in 8 quarters, which was good, both automotive and industrial markets, remember, that 70% of TI's revenue combined saw modest sequential declines. And given how important they are, that hurts the overall performance considerably.
Ouch. And the bottom line for Q4?
Gross margin slipped a bit to 58%. Operating margin fell to 34.4%, down both sequentially and year over year. EPS was $1.30, down 13% from the previous year. And for the full year 2024, free cash flow ended up being a meager $1.5 billion, only a 10% margin. And notably, that wasn't enough to cover their dividend payments for the year. That definitely fueled concerns about the near-term financial picture.
And the Q1 2025 guidance didn't help matters.
Not at all. Revenue guided to between $3.74 billion and $4.06 billion. The midpoint implied another sequential decline of 2-3%. They blamed ongoing smartphone weakness and inventory adjustments. EPS guidance was 94 cents to $1.16, also falling short of what analysts were expecting.
So how did Wall Street react to all this?
Predictably, analysts reacted strongly. Sources say Wall Street analysts have significantly cut medium-term growth expectations. The recovery was clearly going to be far slower than previously anticipated. And this brings up that really interesting strategic question for you to think about. How do you view TI's heavy exposure to auto and industrial? Right now, it's a headwind because those sectors slowed sequentially. But long term, they're seen as the big growth drivers.
Right. Short-term pain for long-term gain, maybe. Or a sign of trouble. A classic cyclical dilemma.
Exactly.
Okay, let's fast forward again to the Q1 2025 results and Q2 guidance reported in April 2025. Did things look any better then?
Yes, a bit brighter. Q1 earnings actually impressed Wall Street. They beat consensus estimates, and crucially, management issued better than expected guidance for Q2.
Ah, positive surprise for once.
A much-needed one. The results suggested that, finally, the analog industry has likely bottomed and that demand across all end markets is improving. That was a significant shift in tone, and the market responded. TXN shares gained 6.5% right after the report and finished that week up 11%. Shows how sensitive investors were to any positive sign.
But were all the concerns gone? Or were there still clouds on the horizon?
Definitely still clouds. Despite the positives, sources noted lingering worries. Heated global uncertainty from tariffs, an ongoing trade war, and a subsequent economic slowdown were all seen as weighing on the outlook, creating considerable near-term uncertainty. So the critical question remained, even with improving demand. Will improving demand and healthy inventories be able to offset the destruction caused by tariffs and an economic growth slowdown? It's still a delicate balancing act. The path forward wasn't entirely clear.
Okay, so with that whole backdrop, the strong fundamentals, the big strategic bets, the roller coaster of recent performance, the cyclical nature of it all, it's really no wonder analysts are all over the map. Is TXN a buy, a hold, or a sell? Our sources give us very different takes, each with its own logic.
Let's start with the bulls, the buy case. This perspective comes from analyst Gaius Ang, writing in May 2025. He issued a strong BUY recommendation. And get this, he projected a 91.74% 5-year potential upside, with the target price way up at $208.56. That's some serious optimism.
Wow. What was his rationale for being so bullish?
His core argument was that the recent dip in the share price created a compelling entry point for long-term investors. He felt the market was overlooking TI's fundamentally strong market position and future prospects, basically getting too hung up on the temporary drag from that heavy Capex spending on free cash flow. He used a discounted cash flow, or DCF, model for valuation, and it suggested TI was significantly undervalued at the price back then. It's a classic value play, betting the market is being too short-sighted.
Okay, so that's the strong buy case. What about the more cautious view, the hold stance?
Right. This comes from Dane at Invest Insights, writing back in October 2024. Now, Dane was very positive on the company itself, calling TXN an absolute gem and a must-own stock for the long haul. But, and this is key, he was explicitly not looking to pick up additional shares at that particular time. He drew a clear line between liking the company and liking the stock price.
What was holding him back then? Valuation.
Exactly. He saw the shares as richly priced, trading at 40x this year's earnings at the time and still looking expensive based on projections for FY25 or FY26 earnings, 34x and 27x respectively. He noted the PEG ratio price earnings to growth looked okay at 1.7, a slight discount to the sector. But he argued the expected growth recovery was already very much anticipated and priced in. The good news was already reflected in the stock price, leaving little room for upside.
So what was his target price back then, and what kind of return did that imply?
His analysis led to an end of 2026 target of $240. But based on the share price in October 24, that only translated to about 4.5% annual returns, maybe 7% if you included dividends. And for him, that return was in no way enough to warrant buying shares at that level. He basically said, wait for a pullback. He suggested waiting for the price to drop towards the $190 per share range before it looked attractive enough to buy more. Patience was the message.
Okay, but then things changed. Fast forward to January 2025, right after those disappointing Q4 results and the weak Q1 guidance we talked about, Dividend's view shifted again.
It did, and quite dramatically. He essentially moved to a sell case. He stated very clearly that, given the new, weaker outlook, the current multiples cannot be justified.
Why the stronger stance?
He said the poor guidance has forced Wall Street and me to reset our medium-term expectations. The recovery was clearly going to take more than previously thought. And even after the stock dropped 7% following that earnings report, it was still trading at 34x this year's earnings. He called that a bloody high multiple for a company facing these kinds of headwinds.
Did he compare that multiple to TI's history?
Yes. He pointed out that historically, TI traded at a high multiple, but usually lower, more like 24, 26x earnings. So, using a more conservative 25.5x multiple on his revised lower earnings estimate for FY27, he came up with a target price of only $195. At the time, the stock was around $185, meaning his target suggested barely any upside, even looking several years out.
So his recommendation then was effectively sell, or at least avoid.
Pretty much. He predicted the shares would remain volatile and trade flat in the years ahead. He thought they needed to fall much further, closer to $155 per share, just to be an okay-ish buy, a strong warning on valuation versus the now delayed recovery prospects.
Okay, let's bring it right up to the latest snapshot we have from April 2025 after that slightly better Q1 earnings report. Did the picture change then?
A little. With the stock having moved, the PE ratio had come down from that 34x level to around 29x. Dane noted that shares were starting to look more attractive on that basis.
But he didn't upgrade his rating.
No, he didn't. Despite the better Q1 demand signals, he cautioned that the underlying situation for TXN has not improved quite as much as the stock's bounce might suggest. He pointed again to that heated global uncertainty from tariffs, an ongoing trade war, and a subsequent economic slowdown, which kept the outlook cloudy. So even in April 2025, his sell rating apparently still stood. It highlights that persistent tension, promising long-term strategy versus challenging short-term macro conditions and valuation concerns. The market was still grappling with how to price that risk.
Right, so with all these complex factors in play, strong advantages, huge investments, shaky recent performance, the whole industry cycle, we absolutely have to consider the risks TI faces.
Yeah.
And just as importantly, how they try to build resilience against those risks.
Absolutely crucial. And the biggest, most inherent challenge for anyone in this business is the cyclicality of the semiconductor industry. It's just baked in. The industry is famous for its boom-bust cycles, driven by inventory swings up and down the supply chain, fluctuating demand in different end markets, and just the general health of the global economy. We saw this directly affect TI with the softening demand in industrial and personal electronics during 2023 and 2024. Even a giant like TI isn't immune.
But TI does have specific strategies to try and lessen the impact of these cycles, right, to build stability.
They do. It's very intentional. A key part is that strong focus on industrial and automotive markets, over 70% of revenue now. These sectors generally have longer product cycles and more stable demand compared to, say, the super volatile consumer electronics market.
Okay.
Plus, as we discussed, their strong balance sheet and cash position act as a critical financial cushion. It lets them ride out downturns and keep investing in their long-term strategy without getting completely derailed.
Okay, what's another big risk? That massive Capex plan must carry some execution risk.
Definitely. That's been central to the whole analyst debate. This execution risk from its Capex-heavy strategy is significant. TI is placing a huge bet, spending around $5 billion per year through 2025 to build and ramp up these new 300mm fabs, RFAB to LFAB. It's a massive undertaking.
And the risk is, what if demand doesn't show up when those fabs come online? Or if they have problems ramping them up efficiently?
Precisely. There's always a risk that demand doesn't materialize fast enough to absorb this added capacity, or maybe they hit technical snags in the ramp up. If that happens, it directly hits their returns on invested capital, that ROIC metric we talked about. It could make the big bet look like a costly mistake. It requires excellent execution and a reasonably cooperative market.
How does TI try to mitigate that risk? What gives investors confidence?
Well, their track record helps. TI has a really strong track record of disciplined capital allocation, generating free cash flow consistently for over 20 years. That builds credibility. Also, management has generally been pretty transparent and conservative in guiding expectations around this Capex cycle. They've tried to provide clear visibility on capacity utilization plans over multiple years. And of course, there's that big potential boost from the $6 to $8 billion from U.S. investment tax credits. That significantly de-risks the financial side of these massive investments. Takes some pressure off.
One source did mention something about internal management alignment. Low insider ownership, new CEO, maybe incentive structures not perfectly aligned with long-term goals. Could that be an execution risk?
That's a fair point to raise, and scrutinizing management incentives is always worthwhile. Low insider ownership isn't always ideal. However, the counter-argument made is that despite those potential structural issues, TI's management has demonstrably prioritized long-term investments, this huge Capex cycle being the prime example. Their actions, spending billions on the future even when it hurts near-term metrics, seem to show a clear commitment to the long-term strategy. In this case, actions might speak louder than the incentive structure details.
Okay, and finally, there's the risk of the market itself, just overreacting.
Yes, the risk of overreaction to financial performance. This is exactly what we've seen play out in the different analyst views and the stock's volatility. The challenge for investors is that they might overlook the causes of TI's weaker free cash flow specifically, that temporary strategic Capex impact. And if they do that, it can lead to mispricing and undervaluation by the market. That creates the very opportunities the bulls are seeing and fuels the debates we've been discussing. It's that core tension again, short-term numbers versus long-term strategic investment. A really tough challenge for any investor trying to look past the immediate headlines.
Wow. What a journey through the really intricate world of Texas Instruments. We started with its foundational role in analog and embedded chips, critical but often overlooked. Then we unpacked those really deep competitive advantages they have, examined that ambitious, maybe slightly controversial, huge CapEx strategy. And finally, we dove into this fascinating, sometimes contradictory debate among the analysts about its value right now and where it's headed. We've seen a company with clear strengths, a solid long-term vision, but also one grappling with those tough cyclical headwinds and facing intense scrutiny over its valuation in the short term.
It's a really compelling case study, isn't it? TI almost perfectly represents a high-quality business caught in this challenging but maybe just temporary phase. The massive investments they're making now are clearly designed for decades of future growth, aiming for continued market dominance. Yet those same investments create these immediate financial headwinds. And the market, or at least some analysts, seem to struggle to fully digest that or price it correctly in the here and now. It's a classic investment puzzle.
So what does all this really mean for your understanding of Texas Instruments? And maybe more broadly, how you approach investing in companies like this? It seems crystal clear that businesses in these cyclical, capital-heavy industries, like semiconductors, really demand a longer-term view when you're trying to figure out their true worth. Like one analyst noted, the real opportunity for building long-term wealth often comes from finding great businesses and then entering at the trough of the cycle. Buying when sentiment is low, but the long-term story still holds up.
But that brings up a really important, maybe even provocative question for you to think about. How do you actually know you're at the trough? How can you be sure it's not the start of a much longer downturn? And how much leeway, how much investor goodwill should a company get when its short-term results diverge so much from expectations, even if it's because of these big strategic bets? It's a really fine line to walk.
Exactly. When does that temporary dip, the one supposedly caused by smart strategic investments, actually turn into a prolonged struggle that might signal deeper problems? And how do you as an investor tell the difference between genuinely strategic long-term investments that are going to pay off big time down the road and just plain underperformance that maybe signals management missteps or a flawed strategy? It's a complex puzzle. There's no easy answer. It really requires digging into the details, thinking critically, and being willing to look beyond those immediate headlines and noisy quarterly numbers. Definitely something to mull over as you navigate your own informed decisions in this ever-changing market.
Well said. Thank you for joining us on this deep dive today. We certainly hope this exploration of Texas Instruments has given you some valuable insights and a richer feel for the complexities of the semiconductor world.
We'll see you next time for another deep dive into the stories shaping our markets.